Welcome. Thanks for joining us on Berman's Call. We're here to take your questions on both stocks and ETFs today. Here's how to get a hold of us. You can call toll-free 1-855-326-6266. You can also email us at bermanscall@bnnbloomberg.ca. Larry, good to see you today.
Good to see you as well.
On Election Day, no less, but it is also a monster earnings week that is coming ahead. What are you watching for this week out of the big players?
You know, a lot of what we've heard so far is cloudy future. What's in the bank has been pretty good. So we've generally seen more companies beat than not, in line with previous trends, but many of them just don't know what to think about the next few quarters of the next year until they have some clarity around the, say, rather volatile policies coming out of the U.S. administration.
Yeah.
There's no other way to color it up nice.
Do you think the election, the decision that is made sort of tonight or overnight will make a huge difference as to what happens forward-looking for Canadian companies?
Not really. I mean, Canada is so leveraged to the health and success of the U.S. economy. Unless we're doing things here in Canada to make Canada great again, I don't think it moves the needle too much. When I look at the proposed policies of both the parties, I might give a little bit of a nudge towards the Conservatives. But what you saw when Carney came in was all the good ideas that the Conservatives may have had. He kind of said, okay, we'll do that, and vote for me, and it's worked.
I think it's interesting because he's former Bank of Canada governor. You have policies that are quite aligned in some areas that you thought would be more divergent.
He is, in my Prime Minister Carney, in my mind, is the most qualified person running a country today that understands the global economy, given his role at central banks in both here in Canada and in the UK, navigating those both jurisdictions through really challenging times. It's not who I'm voting for, but that's I have no problem with Prime Minister Carney, leading the country.
Okay, let's zero in on some of the Mag 7s that are reporting this week. Meta, Apple is reporting. I'm wondering if you can take a look at Tesla, which is already reported, and sort of pull anything out of that will be meaningful to the conversation with the others this week. Or is Tesla such a separate case because of the Elon Musk connection?
Yeah, I spent my winter in Florida, as you probably know. My wife and I were doing some shopping and was next to a Tesla dealer, and I drive a Tesla. And literally weeks ago, it's more like 6 weeks ago now, people were holding up signs outside protesting Tesla. The fact that Musk has stepped away from Doge or planning to and spending more time with Tesla is probably a good thing. But today at 150 times earnings, the stock is ridiculously valued, and I would have that debate with anybody on why that's the case. Now, the lovers of Tesla and the model will tell you, no, robo-taxis, everything else is coming, but, the full-service driving, we're not there yet. Like, I just don't believe it, having tried it myself in my own car for long periods of time. We're not there yet, so...
Okay,
we'll
so
see.
Let's take Tesla and put it aside and look at the other Mag 7s that are reporting this week. And what do you expect? You mentioned, for example, there likely won't be guidance or there might be scenarioed sort of guidance?
Well, so Apple, with the focus on China, and Apple already having to redo their supply chains really quickly, that's the one that's most interesting to me. If you were to hear a Microsoft all of a sudden say, you know what, we're not getting software sales as much in China, something like that would be meaningful. We did hear from Google, so on the cloud side of Microsoft and Amazon, probably good news there. And those are kind of the things that I think I'm looking for and probably most others to hear. I think the guidance is going to be cloudy from everybody.
Got it. So guidance that will be maybe there, but you can't put a lot of stock in it to say.
Again, valuations right now were priced for perfection, and I'm not sure we're going to have that economic outcome in the next few quarters anyways.
Got it. All right. We are going to take a quick break. Coming up next, we'll get to your phone calls and your emails. Here again is the number to reach us. You can give us a call. 1-855-326-6266. You could also send an email, Berman's Call at bnnbloomberg.ca. We're back in a moment. Welcome back to Berman's Call. We're here with Larry Berman to take your questions today. Our first one came in an email from Jacob. It says, I just opened an investing account with a few $100,000. I bought $1,000 of NVIDIA. I have one share of Enbridge. I'd like to manage the funds myself, but I have zero experience. What should I do with all the uncertainty? Do I wait to buy in, or do I just put all my money in the market now? And what would you put it into? So this is a very wide question, and I'm thinking, this poor man has jumped in at an incredibly difficult time. How do you advise?
But opportunistic.
Very,
right?
Sure,
so
he's got the opportunities.
Again, don't know how old he is, don't know his income, so you can't really give good advice.
Sure.
Here's the biggest thing, and I love questions like this too. If you're going to take on the responsibility for doing it yourself, you have to understand your emotional quotient. And that is, if he put in that several $100,000 and did it, 2 months ago, and now it's worth several $100,000 less, 25%.
His heart is probably at his feet.
How would you feel?
Yeah.
Right? In a bull market, everyone makes money. It's all good. Everyone thinks they're smart. It's when the markets get difficult, like now, can you handle the ride? So the most important thing, if you're taking on that responsibility, is your portfolio construction, is your ability that if some kind of volatility event happens like this, that you're not going to panic and run for the exits. And if you don't think you can do that, do not try to do it yourself. Work with an advisor, pay the fee. It'll be worth it if you find a good advisor.
Okay, if you're going to tell him and he still wants to try to dip in, as you mentioned, take advantage of where we are right now, are there one or two ways you would steer him? And I know we don't know if it's long-term or short-term, but let's presume it's long-term if you've just entered into the investing.
Dollar cost averaging, but not the 1st of every month or the 15th of every month. Markets are down 3 or 4% from a recent high. Good opportunity. Markets are a bit cheaper. Get it in. Markets are 10% up from a recent low, and not a good time to put money in. So you want to cost into the market. You want to do it during periods of weakness. How much should you do? Historically, the average pullback in a market is about 13%. Happens all the time, rinse and repeat over the cycle. So if we see an average correction, that's a good time to get more fully invested. If we're in a recession, the average correction's closer to 30%. So those are the two guidelines in terms of, do I go all in? Do I give it the big shove now? And so having been down 20% from the peak, although a very inflated valuation peak, not a bad time to get fully invested a few weeks ago when we were near the lows. Right here, right now, a little bit more caution because we've bounced 10% plus off the lows. If we get back to those lows, give it a shove with at least half.
Got it.
Right? I think the risk return, looking out 3, 4, 5, 10 years, pretty attractive.
Okay. Some good advice there. Let's go to the phones. On the line is Sean. He's calling from Kingston, Ontario. Hi, Sean.
Hi there. Thanks very much for taking my call. Larry, I currently hold ZDV in a taxable account, and I'm considering adding SCHD using my existing U.S. dollars. And with a 10-plus year sort of horizon focus on dividend growth and passive income, would you consider SCHD a good complement to ZDV, considering its maybe tax efficiency and portfolio strength? Thanks very much. Look forward to your comments.
Yeah, you always have to look at what the dividend basket is made up of, because Schwab has them in this case, but so does everybody else.
Okay.
And so, what kind of focus on dividends? Is it the highest dividends? Is it the most robust companies with great balance sheets? So you want to look into that. And I have no problem with the vast majority of dividend-focused strategies out there, but you have to decide what fits for exactly what you're looking for. And to me, the answer is not one style that's better than everyone else's, because from time to time, if you focus on dividend growers, they'll be outperforming. If you focus on more mature dividend payers, more consistent, better performance. right? So you want to get a sense of that, and maybe 2 or 3 different ones would be the way to go about it, as opposed to just thinking one is the better one than everybody else's.
So you would spread it out a bit?
I would like to spread it out between style within the dividend category. Maybe some dividends with covered calls, maybe some dividends with growth attached to them, maybe some dividend aristocrats that have long-term, strong dividend paying track records. Those 3 together, to me, nice basket.
Got it. Okay. Let's go back to the phone lines. And Paul is on the line from Edmonton today. Hi, Paul.
Hello.
What's your question?
Yes, I am a buy and hold investor, and I'm thinking of buying some Brookfield Infrastructure Partners. But I was wondering, should I buy now or wait for a lower price sometime in the future?
Okay, we'll pull up Brookfield in a moment and take a look at that. What's your overall take on Brookfield?
So I think you have to love the infrastructure play. The challenge with this, and let's maybe look at a 10-year picture.
Okay.
Okay. The sectors over long periods of time can get very expensive and they can get very cheap. So that area, not a good time to put money in, right? That area, much better, right? So you have to kind of look at it from that perspective. Where are we now? Looks like right about the middle. So if you're talking about new money that's been sitting in a GIC or something, put half in, because if it goes bad with Trump tariffs, we're likely going to come back down to the lower end of that range. If it goes good, it goes back up, you've made some money. Right here, we're kind of in the middle of the risk range to me for a Brookfield Infrastructure. And I would want to be there long term because I think they're a great operator in the space. Right here, valuations are kind of neutral-ish. So to me, half a position with some powder dry if it gets weaker, and then look down the road
for the next dip.
Because the caller said it was long-term money. So if it's long-term money, you want to place it when it's on the cheaper side of fair value, and we're kind of neutral-ish right now.
Got it. Okay. Let's go back to the phone lines, and we have Peter on the line from Montreal today. Hi, Peter.
Hi. Mr. Berman, my question is on Lightspeed. With Donald Trump's tariffs going up and down all over the place, people not knowing what to do, would now be a good time to buy a Lightspeed? How do you see it affecting Lightspeed's business? Would you buy it for the long term, and do you own it? Thanks very much. Have a nice day. I appreciate the call.
Can you tell me a little bit about Lightspeed?
Yeah, it's a tech processing.
Like a cloud company?
What's that?
Do they have cloud company?
Yeah, software as a service, platform as a service type company. If you look at, again, let's look at a big picture here, 5 years, maybe 10 years, if we can get a longer term history here.
So here's your 5 years.
You had a massive run up during COVID and the recovery, and then it's been a terrible story ever since. You've got this long-term base developing, so technical people kind of like that thing, but this is a stock that's going to give you 2 times the volatility of the marketplace, right? Because it's in a growth area, and if you look at their balance sheet and everything else, you kind of say, okay, this is not a strong, solid company. So it's a bit more speculative from that perspective.
Okay.
It's not expensive at the moment. And they do make money, but play in a very narrow niche. It made a low very recently in the 7 and change area, and currently just over 10. So big move up from the recent lows. I would say at this point, for these more speculative names, I'm a bit cautious on market. So no, I don't like it here. If we get a retest of that low that we made a few weeks ago, and it holds, that would, to me, would be a better entry location. And I think the risks are fairly high, especially if we're going to go into an economic downturn, that we revisit those lows at some point.
Got it. Okay, let's get back to the phone lines then. Kevin's on the line from Hamilton in New Brunswick. Hi, Kevin. Kevin, are you there? Okay, we may have lost Kevin. So I'm going to move on. We have an email now from TAC. TAC says, hi, Larry. Thoughts on XDIV as a core portfolio?
Again, I talked about type of dividend exposure. So this is a high quality dividend index. And so these are mature companies that have been consistent, steady Eddie payers, focused on Canada. So what is that going to look like? It's going to look like the bank, insurance companies, some of the big energy plays. So I have no problem. But should that be the core of your portfolio? That would be the question I have. And I would probably need to go back and ask a lot more questions.
What kind of questions would you ask in order for that to be the core part of the portfolio?
Biggest question, is this taxable or not taxable?
Okay.
Right? Because if this is a core holding, it doesn't matter that if it's in a registered account, because the tax treatment is when you take the money out of that account. Do you need any current income? Right, so those are the things I'd want to scope out in terms of figuring out if this is appropriate or not. No issue at all with ex-div as a holding. Okay. Should it be the core? That's something I'd have to explore a little bit more.
Okay, then let's try and get another email, and this one from Bill. I'd like to get Larry's view on ZPay or ZPay. Its cash holding seems to have increased a bit. I'm wondering what's going on with the ETF.
Yeah, so this was an ETF that I was involved with Bank of Montreal and helped developing going back 5-6 years now. And I love it, and we use it in our strategies. And this targets about 50% position in a long with a covered call, and then 50% holds a T-bill, and they sell puts to generate income.
Okay.
So this strategy, option overlay strategy plus the dividend is designed to yield about 6%, and they pay out 6%. And overall, it has about half the volatility of the U.S. equity market.
Okay.
So it's a very, very high dividend payer. It's got tax efficiency because a lot of that dividends off the options are treated as capital gain. So it's a very, very tax efficient strategy. And I love it for that reason. And I wouldn't worry about the short term, do they have a little bit more cash now than not? But those are the parameters of how they run the fund. I don't believe they've changed them at all. And so maybe the data you're seeing is a bit stale, or, with the fast movements in markets recently, there's a little bit of a change. I wouldn't worry about it at all.
All right. On that, we do have to take a break. But coming up, today's educational segment from Larry. We're back in a moment.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Welcome back to Berman's Call. We're here with Larry Berman. Time for his educational segment. Today on the NASDAQ 100 and what it has to say. Larry.
Technical analyst likes to try to understand what the message of the market is by looking at the behavior in the charts. So one thing, we went out last week on a high note. When we were sitting here last Monday, markets were selling off. We were at the lower end of the recent range. And so the markets went out on a high note. But for the NASDAQ 100, literally, we were within 1% of the closing level of the April 2nd close. If you remember, April 2nd was Liberation Day. And initially, after the close, when Trump started saying, going to be flat 10% across the board, markets, that's not so bad. And markets rallied higher. And then he came out with that chart of
the big board
of all the crazy, I don't know how to say
percentages
it.
of however they came up with
incorrectly
that, yes.
calculated it, and et cetera. And then the markets for 3 days went, blah.
Yeah, of course.
Right. So the psychology of the market being back at that level, in a few days now before Microsoft, Apple, Meta, Amazon. So this is 26% of the NASDAQ 100. It's 19.2% of the S&P 500 that we hear from this week. I mean, there's others too, but these are the big behemoths of the Mag 7. And so what is the market telling us? Market's telling us we're still in a very manic mood. But being back at that April 2nd level, is it telling us we don't have to worry about Trump? Markets are through it. We had the bump, and we're good to go here. I can't believe that for a minute. I think we're just getting going, given Trump's style. But they've done a very good job post April 9th, walking it back from the brink. Last Monday, as we sat here, apparently he was having lunch with some CEOs, and they said, Mr. President, you can't do this, right? And then they walked it back even more last week. So when we look at the charts here, we can see there's April 2nd, and there's the level. So intraday high was a little higher, but literally we're within 1% of that now. Now, an hour and a half ago, we had a bearish engulfing pattern today. And as we sit here right now, the S&P is back to positive on the day, and the NASDAQ's only down a little bit. So the message right here, to me, is clear. There's a tremendous amount of psychological resistance in the charts around these levels from that new information the market got on April 2nd. So what needs to happen now for us to go higher? To me, we need to solve this trade thing. So how close are we? I'm asking you.
Nobody knows.
Nobody knows is the answer.
Especially in China.
Should the market continue to go up here? And so what we have here too is the 200-day average.
Okay.
And the 200-day average has been rallying since the lows in 2022. But very recently peaked, the market broke below, and now it's starting to crest over. So this is the early stage of a bear market, unless we can get back and hold above that 200-day average. So again, what needs to happen? We need to resolve these trade issues. That's not happening, in my mind, anytime soon, and certainly not within the 90-day window. You will see a memorandum of understanding that we have a deal with Japan and Korea, and that's still to come. So we could still squeeze higher towards this next area of resistance, which is the falling 200-day average. But folks, don't believe for a minute we're past the volatility period and the uncertainty around the economic outcome here. I can't believe that. I believe we will retest these lows some point in the next few quarters as the real economy starts to feel some of these aftershocks of the volatility here.
All right, more to come. So next Monday could be as exciting a week from now. We have to leave it there. Larry Berman, thanks for joining us. You've got options if people want to follow you, YouTube, LinkedIn, www.etfcm.com. That's it for the show today. Thanks for joining us. We'll see you again next Monday.